Good evening. Thank you so much for coming. My name is Wright. I'm the Research Director here at the Federal Reserve Bank of Minneapolis, and I'm very happy to welcome you here to one of our Conversations with the Fed series. Today we're going to talk a little bit about what the Fed is, what the Fed does, and a little bit about also what the economic outlook is, before turning it into what this event is meant to be, which is a conversation. We'll open it up to questions from you. Now, before I say anything else, I'm obliged to say that everything I say today is my opinion, doesn't represent those of the Federal Reserve Bank of Minneapolis, the Fed system, my boss Neil Kashkari, the chair of the Fed in Washington, Jay Powell. If I say something silly, egg is on my face and my face alone. So just as long as we're clear on that. So the plan, as I said, is I'm going to talk a little bit about the Federal Reserve System, try and give you a sense of the way things work, the way things operate. And then I'll talk a little bit about the economy and how things are going. I'll talk about the national economy and how that influences what we're thinking about with monetary policy. And I'll also try and compare it to what's happening here closer to home by comparing it to the state of Minnesota and Wisconsin for comparison purposes, as well as looking a little bit at what's happening in the Twin Cities metro area. Now, I'll try and keep it going a little briskly so that we have plenty of time for questions. So let me start off by talking a little bit about the Federal Reserve System. And the Federal Reserve System is, in a nutshell, America's central bank. Now, before I tell you what that is, I always like to start and say, prior to the Fed being formed in 1913, there were actually two previous central banks in the United States. Both of them set up by legislation and allowed to expire after 20 years. So I think that's kind of important because it kind of sets the framework for why the Fed was set up the way it was. And it also, if you look at what people were saying at the time, it kind of reveals there was a certain level of instinctive distrust of having a central bank in this country at all. The fear was, I think, that you'd get a group of men, and of course back in the day it would have just been men, who would have gathered round a table in a smoky room with glasses of bourbon and cigars and decided things somewhere in New York or DC for the entire country. And because of that distrust, these were only ever authorized for short periods of time, and they were allowed to expire. It wasn't until the very beginning of the 20th century, where there was a very big financial crisis, that the nation begrudgingly said, all right, it's time we have to set up a central bank that's going to last. And that happened in 1913. And the way it was set up is quite different to in most other countries, and it's because of that instinctive distrust. This is, of course, I say this also because I know there are many people out there who continue to be distrustful of the Fed, and I just want to reassure you that not being distrustful is in some sense un-American. So feel free to ask any questions you have today. All right, so what is a central bank? Well, let me tell you what it is by telling you what we do. And essentially what the Federal Reserve System does is three things. The first thing it does is it supervises and regulates banks. Large banks, chiefly, the big bank holding companies like JP Morgan Chase or Wells Fargo, Goldman Sachs, Citigroup. There are lots of other financial institutions in the economy that we do not have the authority to supervise, we don't have any say in. And sometimes that can become an issue, but those are the ones we supervise, and that's the first thing that we do. The second thing that we do is we provide financial services to the economy. So if you've ever had an automatic check payroll deposit into your bank account or an automatic deduction to pay a bill, chances are we had some hand in that somewhere. That's what I say when I say we clear financial services, we manage financial services. We also provide liquidity for banks to cover short-term needs. And in the event of a big crisis, we're what's known as the lender of last resort. We can step in and lend to banks to help them out in the event that they really face a crunch. And then lastly, what we do is we set monetary policy. We influence interest rates in the economy with a view to affecting the outcomes in the economy. And that's primarily what I'm going to be talking about in a moment. So how do we do this, and how is the Fed system set up? Well, it's actually set up in quite an elaborate way. On top of everything, of course, is Congress. Congress set up the Federal Reserve Act, they passed it, they tell us what to do. But within that basic framework that Congress set up, there's a lot of independence in the Fed system. So we have in DC what's known as the Board of Governors, and this is actually an agency of the federal government. Side by side with that, we have spread throughout the country 12 Federal Reserve banks. We sometimes refer to them as regional feds, and the Minneapolis Fed is one of those. Now, the leaders of those feds and the governors who are appointed by the president and confirmed by Congress, by the Senate, together form the Federal Open Market Committee, and it's that committee that determines monetary policy. And at the top of all this is recently confirmed Board of Governors Chair Jay Powell. He just came in a little over a month ago and replaced the previous chair, Janet Yellen. So the Federal Reserve Bank of Minneapolis is one of the 12 here, one of the cogs in this big machine. And this is how the 12 different district banks are spread across the country. Now, the Fed system was set up in 1913. Back then, everybody lived in the East Coast. That's where most of the feds are. The Federal Reserve Bank of San Francisco covers an enormous chunk of the country. And of course now, its economic activity on the West Coast has grown so much that the San Francisco Fed actually manages and represents a large chunk of the US economy. So some of these other smaller ones, if you did it today, you'd probably redistribute these. But this is how it was set up in 1913. And as you can see up there, the Minneapolis Fed is the 9th moving westward. And we often refer to ourselves as I-9, I being the 9th letter of the alphabet. To zoom in on the Minneapolis Fed district, the 9th district, you can see that we cover the entirety of Montana, both of the Dakotas, all of Minnesota, the western part of Wisconsin, and the upper peninsula of Michigan. So we have a fairly large coverage area there. And our job within that broader system is to supervise the banks in this district, to offer services to this district, to monitor what's happening in this economy, this regional economy, and to represent that economy when we go to Washington. And indeed, that's part of why we have events like this, and why we spend a lot of time and a lot of effort going out there and talking to members of the community, business people, community groups, labour leaders, and so on, is because to monitor the developments in this region, we need to be talking to people who are in this region. And then we take that, we distill it, and we bring a summary of that to Washington when we represent you 8 times a year at these monetary policy meetings, these FOMC meetings. So what happens at these meetings? Well, I told you it's kind of representatives of the 12 regional feds and the Board of Governors. In fact, normally speaking, or ideally, there would be 7 governors at the board who would all be voting at this meeting. At the moment, 4 of those seats are empty. So there are only 3 actually on staff at the moment. Those 3 or 7 in a normal situation combine with representatives of each of the different regional feds, 5 of which at any one time are allowed to vote at the meeting. The New York Fed always gets a vote. It's kind of first amongst equals because it's the Fed that implements a lot of monetary policy. And then the other 4 positions rotate throughout the system. Last year, my boss Neil Kashkari was voting in that meeting. And if you've been following along, he actually voted against raising interest rates 3 times. This year, however, he's not voting. He gets to say his piece and maybe influence people, but he does not get a direct vote. Now, what do those meetings look like? Well, here's a picture of them. Now, as you can see, it's not a dark and smoky room at all. It's actually quite bright. There's no smoking allowed. Nobody's sipping bourbon, no alcohol allowed in the room. It's still mostly men, and everyone's wearing a suit. But it's not quite what people might have feared. This picture is actually taken over a year ago before I became the research director, and things have changed a lot. If you look in this picture in the middle, that's Janet Yellen, who was at the time the chair of the board. Now, this is Jay Powell. He's moved over and he now sits over here. There's been a bunch of changes. A bunch of these people have left. The regional Fed presidents are mostly the same. This handsome bald head here is Neil Kashkari. You can't see his face, which is too bad. It's even more handsome than the back of his head. Next to him is the president of St. Louis, Dallas, Chicago, San Francisco. That's John Williams. He's been in the news a fair bit recently because it's rumored that he might actually be moving to the Federal Reserve Bank of New York. Currently, that's Bill Dudley, who's this thing is, I can't get this laser pointer to work, but he's the guy without a coat on up there, I think. It's a little blurry. Now, I wasn't a research director at the time. My predecessor in the job, Sam Schulhofer-Wall, is sitting up there taking notes quietly in the background. I don't actually sit in that seat when I go. I've moved over one seat because I find it's much easier to look over the chair's shoulder and read what they're reading one seat over. So I actually sit 2 seats over there. But that's how it looks. That's how the meetings go. We just came back from one a little over a week ago. So what do we do in these meetings? Well, we decide on monetary policy, which is essentially we decide on how we want to try and influence interest rates. But we don't just go about changing interest rates however we want to. We have been charged with changing interest rates in order to attain 2 goals. Those goals were set forth by Congress in 1977, and those goals were defined to be maximum employment and stable prices, what we refer to as our dual mandate. And it's those 2 things that we look at. We look at many different variables, as I'll show you in a minute, many different indicators of the economy, but all of which are speaking to whether we're at maximum employment and whether we have stable prices. Those are the 2 things that we look at, and those are the 2 things that I'm going to talk about for the rest of our time. So let's start with maximum employment. What is maximum employment? The truth is, nobody's entirely sure. Congress didn't lay out a definition for us. But what we tend to look at most is measures of unemployment. People who don't have a job but are actively looking for one. Now, the statisticians in Washington have come up with all sorts of different measures of this, but the main measure we look at is here in black. The statistician has called it very imaginatively U3, but this is what we would say is the official unemployment rate for the economy. And as you can see, over the last 12 years or so, 11 years or so, the unemployment rate started prior to the Great Recession at a little under 5%. It rose up to around 10% by 2009, and has since trended down, all the way down to 4.1% today. So looking at this measure, we seem to be back where we were in the boom before the recession. Looking at this measure alone, it kind of looks like we might be at something approximating maximum employment. Now, some people argue this is way too narrow a measure. There are lots of people, or especially at the height of the recession, who were looking for, who may not have been actively looking for work but wanted a job. There might have been people who took a part-time job out of necessity when they really wanted a full-time job. And when you include those people, you get a bigger measure, what I would call underemployment, and what the statisticians call U6, and that's this orange line here. It's always higher than the unemployment rate, and it rose to about 17% in 2009, the depths of the recession. It's since recovered, and it's round about the level it was before. So looking at these 2 measures, we're kind of back where we were before. Maybe you'd think we're back at full employment. Now that doesn't, maximum employment. Now that doesn't mean that the benefits of this have been shared equally amongst society. Here's a plot that breaks down the unemployment rate by race. The blue line here is for whites, and as you can see, and here we have the most recent data blown up larger, the unemployment rates for whites is quite a bit under 4%. I've got long arms, I can tend to reach up anyway, but just in case, a little lightsaber. All right, so whites are doing better than the average. People who are Hispanic, around 5%, a bit worse. And African Americans, almost twice the level of unemployment as whites. And indeed, as you look historically, African Americans are typically being unemployed at twice the rate of white Americans. So, things are better, it's gotten better, but it's still not great for African Americans by any means, and for Hispanics as well. So you might think that white Americans are close to maximum employment, but you might think we've got a way to go for the rest of the economy. What about the region? Well, here I have both of those measures, the unemployment and underemployment rates for the US, as well as for Wisconsin and Minnesota. Minnesota in red, Wisconsin in blue. And as you can see, both states are doing better than the nation. Unemployment, the official rate, is a little over 3% for both, well below the 4.1% for the nation as a whole. Likewise, the underemployment rate is quite a bit below the level in the rest of the nation. So the local economy doing pretty well. Zeroing in even more on the Twin Cities, here I've got the Twin Cities and for comparison purposes Rochester, and you can see both are doing very well, even better than the rest of the state of Minnesota, with the unemployment rate, the official unemployment rate, under 3%. Rochester's beating us out here in the Twin Cities, but we're pretty close. So the local economy seems closer to maximum employment than the national economy, perhaps even beyond what we would think is a sustainable level of unemployment. Now, that looks pretty good, but there are other measures of the economy and the labour market that we look at that suggest that maybe we're not at maximum employment after all. And this is the quandary that we're thinking about as we think about raising interest rates. So here I've got two other measures of the labour market. One, which is the level of employment relative to the working age population. And this is basically everybody from 15 to 64, what fraction of them work. And you can see it's about 60.5% of people. It used to be up above 63%. So even though the economy's recovered, employment is low relative to what it used to be. The orange line is the labour force participation rate. It's at about 63%. It used to be up over 66%. So it's lower too. Now you might think, well, you know, as people get older, they tend to work less, and we know the population's getting older, so maybe that's driving some of this. And it is, but it's not the whole story. If I zoom in on people who are in the prime of their life, prime age, people aged 25, they've finished college, up to 54, most of them haven't really seriously considered retirement yet. You can see that both the employment percentage and the labour force participation rate are still below the levels they were prior to the crisis. So when you look at something like this, the picture's not quite as rosy. There's still people, a smaller fraction of people are working than they used to be, and a smaller fraction are working or looking for work than they used to be. So whereas the unemployment picture was quite rosy, this picture, employment and labour force participation, is a little bit less rosier. And that's why we're a little conflicted as we think about things. You could do this for the state as well, and what you can see here is that people in Minnesota and Wisconsin work more than in the rest of the country. More of them are employed, more of them are participating. More Minnesotans are, in fact, working or participating than Wisconsinites, which is a mark of pride, I guess. We don't sit around, we're out there working. Those people in Wisconsin too busy eating cheese and supporting the Packers. But we're also below where we were before the Great Recession. So even though things have gotten better, they're still not as good as they used to be. And that's a caveat to the story that we think the labour market's getting a lot stronger. So now let me turn to stable prices. I should stress that, you know, traditionally we tend to think that as the economy gets stronger, as the labour market gets tighter, as unemployment falls, we would expect inflation to take off. So we tend to think of there being a trade-off. We can have lots of employment, low unemployment, but if we do that, we might have to have rising prices, inflation. Alternatively, if we have less employment, more unemployment, we have more stable, perhaps even falling prices. So we typically think of this as a trade-off. I mean, the big shock to us has been that prices really haven't grown fast, even as the economy's gotten stronger and more people have found jobs. So this is our favourite measure, the measure of inflation that the Fed focuses on. It's called the Personal Consumption Expenditure Inflation Rate. Just we like mouthfuls, you know, a nice big name. We'll abbreviate it to PCE. And you see the blue line is the rate of inflation of that measure over the last 11 years or so. And what you can see here is that it's pretty volatile. It jumps up just prior to the recession. The recession is this grey period here. It falls quite a lot. It actually goes negative at the end of the recession, jumps up again. And that's driven by things like oil, food prices, things that are affected by the weather and so on. And because that can give us a misleading signal about what's actually happening, we tend to focus on the core part of the price index, the prices of goods and services that are not as affected by oil or by food that might be affected by the seasons. And that's this orange line here. And so technically what the Fed is trying to do, or at least has been trying to do since 2012, is to get this orange line, the rate of core PCE inflation, up to 2%. That's our target. Not a ceiling, a target. We try and hit that. We can go a little above, a little below, but we try and hit that number. And what you can see here is that with the exception of this brief period around 2012, we've been below that 2% number since the crisis. In fact, since we adopted that target, we've actually fallen short of the target in every year. There was a while there where we thought we were getting back, but then last year it kind of weakened before getting stronger again. So we're not getting the kind of inflation you might think you'd get at this point of the cycle. We're falling a bit short of our target. Now, this is something we're watching very, very carefully. If there are signs that inflation is going to take off, that will be a sign that we might actually be at maximum employment and it might be time to start raising interest rates more aggressively. And we know that there's going to be a jump in inflation in 2 months' time. So this here is the annualized rate of inflation that occurred in each month over the last 13 months. And what you can see here is that in March of 2017, there was a big negative number. A couple of things happened that month, but one of the biggest was that Verizon started offering unlimited data on its plans. So suddenly you got all this extra data for no charge. That was a decline in the price of data on your cell phone. And that drove this large negative number. And we know that come March this year, that negative number is going to disappear. We're going to get something that's probably not negative at all. So we know that the inflation rate is going to jump up in March. We're expecting that. But we also know that it need not necessarily portend anything particularly bad. So that we're going to be paying very close attention to that. We know it's going to jump up. We're not going to freak out. Please don't freak out too. But we're going to be looking at it very closely at that point. Now, I want to make sure there's enough time for questions, so I'm going to go a little bit quicker through the rest of it. Essentially, Minnesota and Wisconsin, or in this case, specifically the Twin Cities, and for comparison purposes, Milwaukee, representing Wisconsin, look pretty much like the national economy. This here is actually something called the Consumer Price Index, a little bit different to that PCE measure I talked about, but they all pretty much track the same. Inflation level's a little bit higher. This particular measure tends to be a little bit higher, so we're not concerned about that, but pretty much following the national economy. No major differences across the states. Another thing we worry about, though, is it's not so much what inflation is now, but what it might be in the future, in particular what it might be 5 years from now. There's no evidence from surveys of professional forecasters or households that inflation expectations for the future have really started to rise. This SPF, the Survey of Professional Forecasters, pretty flat at 2%. The people who fill this in, though, they're kind of Fed groupies. So they kind of believe whatever we tell them, so I don't tend to put too much emphasis on that. This is what households think. They've tended to think inflation's going to be higher than it's actually been, but their expectations have drifted down over time and have pretty much stabilized. A little bit of an uptick recently, but we've seen upticks before that have come back. So we're not particularly worried about evidence of what might happen for inflation. Other people don't seem to be expecting it to rise either. You can look at markets and fancy derivatives to get similar measures. They've come up a little bit recently, but they're also pretty stable too. What about other things that might feed into inflation? Well, as unemployment falls, we might worry that firms have to start raising wages to attract workers and that they may eventually pass that on as higher prices. And that might lead to inflation. So another thing we look a lot at is what's happening to wages and compensation of employees. The blue line here is what's known as average hourly earnings. It's like the average wage per hour across the economy. And what you see is it's slowly trended up, but it hasn't really taken off, despite the fact unemployment has come down a lot. So not particularly concerning. We hope, in fact, that people's wages are going to rise a bit more strongly than that because we want people's living standards to rise. This green one, which fluctuates all over the place, tries to include a broader measure of compensation, your healthcare benefits, your pension benefits, and so on. It's very volatile. We don't really know what to make of it. This last spike might be concerning, but we've seen these big negative ones before too, so we're not terribly alarmed. And this orange one is another measure of employment costs, and it's been kind of trending up a little bit too, but doesn't appear to be exploding. Nothing necessarily to worry about. What about locally? Well, let me show you what the data says for Wisconsin and Minnesota relative to the nation. The nation's in the black line, Minnesota red, Wisconsin blue, and as you can see, the numbers for the states are pretty volatile. And that's mostly a reflection of the fact that the survey doesn't have that many people in Wisconsin and Minnesota in it, and that can knock things about a little bit. But what you see here is that, they've been kind of tracking. There was a period of a lot of wage growth in Minnesota, but recently it's started to slow down. Wisconsin has actually picked up a little bit more recently. Not entirely sure what to make of that, but it certainly doesn't look like we're doing much better on average than the rest of the economy. Not too different. More fluctuations, but that could just be measurement error. Potentially importantly though, it has come down a little bit recently. And you get much the same picture if you look at Rochester and the Twin Cities. There was a bit of an increase in wages in 2016-17, and they've started to come down a bit more recently. So exactly why that is, we can talk about if you're interested. So what are the takeaways before we go to the questions? Well, the national economy continues to get stronger, slowly stronger month after month. Are we all the way to maximum employment? Well, we're doing okay on the unemployment measure, but some of those other measures are a little bit so-so, so we're not sure. And so far, at least, prices are stable and are expected to remain so. Wages aren't taking off, compensation to workers isn't taking off. For all of those reasons, the view here of our boss, Neil Kashkari, has been, we don't need to rush out and raise interest rates. That's why he dissented 3 times last year. But we were in a minority, and so interest rates were raised anyway. How is Minnesota and the Twin Cities doing in comparison? Well, a little bit better than the national economy. Unemployment rates are lower, wage growth was a little bit stronger for a while, inflation growth was about the same. But interestingly, and possibly disturbingly, wage growth has gotten a little bit softer recently, and that bears watching, and we want to understand why that is. Is it a true fact? Is it something we need to worry about? We'll be paying close attention to that. That's the takeaways. Thanks so much for listening. I'm available to take your questions.
If you have a question, please raise your hand and wait until we bring you a microphone.
Why would you worry about wage growth being slow?
So ultimately, what the economy is about delivering higher living standards for people. So ultimately, we want to see people's incomes go up. And the largest single part of a person's income is typically their wages. So in the long run, we want wages to rise. So that's why I say we don't want it to be too low. Now, if it grew very, very quickly relative to the economy, then I might worry that this is just going to be passed on as higher prices and higher inflation. It's not going to be a true, real increase in your wage. But ultimately, we do want wages to rise in the long run, slowly but steadily, as people's living standards get better.
What is your opinion as to why inflation hasn't picked up in this recovery? And second of all, what effect do you think the new tax act will have on the rate of inflation?
Okay, so this is in some sense the question we're all wrestling with. As I mentioned, we typically think that as the economy gets stronger and the labour market gets tighter, we would see inflation take off a little bit, and we haven't. So there's a couple of possible explanations. One is that the labour market isn't really as tight as we think. When I showed you that data on labour force participation and employment, it isn't all the way back to the level it was prior to the Great Recession. And so maybe it's not as tight as you'd think just looking at the unemployment rate. So that's one possible explanation. And to the extent that that's true, we shouldn't be afraid to let the economy keep growing. We don't need to be quick to raise interest rates. Another possibility is that maybe our inflation measures are wrong. Measuring inflation is hard. It's easy to say, well, the price of beans went up from one period to another. But it's really hard to say what's happened to the price of a car or a laptop computer or a cell phone. Because each new one has a lot more features than the previous one. So the statisticians in Washington have to look at it and say, well, of that extra increase in the price of a car, how much of that is really an improvement in quality? I mean, the new car has a fancy alloy that's going to protect you in the event of a crash. It has a new rear view camera. The old version had 5 cup holders. The new one has 10, so everyone can have 2 drinks each in the car. All of those things are worth something. How much of the increase in price is that increase in quality, and how much of it is true inflation? If we're not doing that calculation correctly, maybe inflation is actually stronger than we're measuring it, and then we would be a little bit concerned. There are other things going on too. We know there's a lot of competition from around the world, from other countries that might be lowering prices. We know big companies like Amazon are extremely aggressively pricing, and that might be limiting the ability of other companies to raise their prices. And maybe there's some structural transformation that's cutting into firms' profit margins and keeping prices low. And we're trying to get to the bottom of that right now. And there'll be a conference in Dallas in a month or so asking this question. Next time my boss and I go to DC, we'll be asking that question too. That's really what we're all wrestling. Now, to get to, I've already given you a long answer. To get to the question on the tax reform, we do expect the tax reform will stimulate the economy to grow a little bit more than it otherwise would have. It's going to happen over a couple of years. It's not all going to be right now. But we do expect it will continue to stimulate the economy. We do expect that will cause things to tighten. We do expect that might lead to inflation emerging earlier than it otherwise would have. But for the same reasons we're not sure why inflation is not high now, we don't know exactly how much inflation is going to pick up as a result of that.
Thank you for your comments. My question first is about the gathering of data. For instance, a larger proportion of our workforce is self-employed. And does that handicap your ability to track unemployment? And then secondly, if you're relying on telephone surveys, it's hard to find anyone home during the day, and you don't know their cell phone numbers. And a second area, did you set the 2%, is the 2% target, is that based on anticipated economic activity stabilizing at 2%, or is it based on an expectation of the population growth of 2%? Or both?
Okay. So the first question was, how do we measure unemployment and how is that affected by self-employment and things? So, when the statisticians look at the economy and they try to measure what's happening in the labour market, they actually run multiple surveys. One source of those surveys is of firms, employers, and that gets a good measure of exactly how many jobs there are in the economy. That doesn't translate exactly into unemployment. Some people hold multiple, or even employment for the population, because some people hold multiple jobs. And as you said, if you're not reaching the self-employed, you might not be catching that. So the second thing they do is they survey households and ask, are you employed right now? And the measure of unemployment is derived from that survey. Now, to the extent that people are answering the survey correctly, that I'm self-employed and therefore I'm not unemployed, it is being picked up. But there's always a question as to whether a person is maybe looking for a job but can't find one, so is selling a few things on Etsy to make a few dollars on the side. Are they truly self-employed? Is that is that going to be their long-time occupation, or is it just something they're doing for the time being? And one of the reasons we look at these broader measures like underemployment is it might capture people who are part-time self-employed but really want a full-time job. So we're trying to get at it. Now, to the extent that we do look at phone surveys, it used to be a big problem that we wouldn't call cell phones. The statistician would only call a landline, and obviously a lot of people are getting rid of their landlines now. But we also do surveys where we go out and interview people in person. We take them through the survey as well. So it's becoming harder and harder to get people to answer surveys. but the statisticians are doing the best job they can. Another source of information I might add is tax returns. Tax returns, if you file a Schedule C as self-employed, you'll show up there. And so the statisticians are also looking at that as a way to benchmark their other surveys. So they're doing the best they can. We don't have no reason to believe they're doing a terrible job, but it's certainly possible that some things are falling through the cracks. Now, why did we have a 2% inflation target? And that's a good question. I think there are really a couple of reasons. The first reason is, as I mentioned before, measuring inflation's hard. You know, there are lots of reasons to believe that we might actually be mismeasuring inflation, and most of those reasons suggest that we might be overestimating it. So we chose 2% rather than, say, 0, in part because we wanted to allow some room for, if we are overestimating it, we didn't want true inflation to be negative. So we aim for 2% measured, thinking that maybe the true rate is maybe a little bit less than that. So that's part of the reason we chose a positive number of 2. A second reason is that, you know, we influence the economy by setting interest rates. And the interest rates people will pay or will ask for when they're saving, you really can't drive those interest rates negative, right? If it cost you, if you went to the bank, deposited some money and the bank said, we're going to charge you for that privilege, you probably wouldn't keep your money in the bank. Maybe you'd buy gold, maybe you'd buy bonds or shares or whatever it is you'd do. So it's very hard for us to lower interest rates below 0. At least we can't do it very much. So by having a 2% inflation target, we're actually in some sense raising the average level of interest rates, which gives us some room to lower them in the event that we need to stimulate the economy. Those are 2 of the reasons. There's a couple of other reasons too, but those are the main things that we were focusing on.
Hi, Mark. Thanks for taking the time today.
Yeah.
Wondering if I could press a little bit more on the tax reform and the inflation piece. So we've seen a lot of folks come out and make big splashy announcements about wage rate increases and bonuses and those sorts of things tied to that. Do you have a view on if inflation comes? Is that all wage rate? Is it kind of wage rate plus other things? I'm specifically trying to understand like how you think that may impact wage rates, I guess.
Yeah. So it's a good question. I mean, I think one thing that I feel confident in asserting is that the average firm is trying to maximize their profits for the owners of the firm. They don't want to just cut wages to the bone because they realize that can lower employee morale, increase turnover, do lots of bad things. But they certainly are not, you know, for the most part, generous souls who really want to pay a lot of money to their workers. As a result, the fact that you might be making more money available by lowering taxes, it's not clear that they have any incentive out of the goodness of their hearts to pass that along to workers per se. I suspect mostly what they're going to do is return that to their shareholders. And we're seeing that with a lot of the large corporations buying back stock and so on. Despite all the nice anecdotes and the nice stories in the newspaper, it doesn't seem to be showing up in the data. Now, I would say another factor we think is at work is that, you know, it's an incredibly competitive, aggressive environment at the moment in terms of firms. And in particular, the big wholesale retail firms like Walmart and Amazon are ruthless with the firms that are supplying them goods. And what we've been hearing anecdotally is that those big firms are saying, wow, you guys just got this tax break. You can now afford to offer the same stuff to us cheaper. So those firms that might have done better are now getting squeezed by the people they're selling to. And so they are finding it even tougher to pass any money back to their shareholders, let alone to their workers. So I don't think it will flow directly into wages that way. I think where it might is that if in the future firms invest more, they grow, that might in the future grow the business to the point where they can pass that on to their workers. But that's going to take some time. I don't think that'll happen immediately.
Two questions. If we want to send you follow-on questions is in an email form, is it your name at minneapolisfed.org? Is that
That'll work.
Okay,
I got a couple of different email addresses, but that'll,
Okay, well,
yeah, that'll work.
all right.
You can also send them to me on Twitter if you want the whole world to know the answer.
Right.
You know.
All
Or
right.
direct message them if you don't.
Right. Now, the question as far as accuracy of measuring cost of living increases, food manufacturers have been keeping the price of a carton of Haagen-Dazs or the price of a package of pizza the same, but reducing the package size, which means that 8-10% increases, but the SKU of Haagen-Dazs that used to be 16 ounces is now 14 ounces. Do you get your information? Does the Fed get its information on food prices from the Bureau of Labor Statistics or some other group, or do you inquire with your own surveys? And a follow-on question is that our politicians in both parties continue to move this country toward the Russian socialist form of government. More and more people are having their cost of living given to them by the federal government, whether it's housing vouchers or SNAP cards or access to food shelves. Inflation in the cost of taxes around here is 4 or 3 times the wage rate increase. You know, if you live in Minneapolis, your property taxes are going up 8-10% a year. Your sales taxes combined on certain purchases are 14% now. But the government is paying for cost of living things. Do you measure the cost of paying taxes as an element of living cost inflation?
I'm not going to bite on the whole thing about whether we're going to a socialist economy or not, but let me try and answer. So first of all, we get data from the Bureau of Labor Statistics and from the Bureau of Economic Analysis. The Bureau of Labor Statistics produces that thing called the Consumer Price Index, which I showed you, but is not the thing we focus upon. Instead, we focus on data produced by the Bureau of Economic Analysis, and one of the reasons we do that are the things you kind of alluded to. So the Consumer Price Index measures the cost to you of healthcare. The Bureau of Economic Analysis measures the cost to the economy of healthcare. So if the government is subsidizing it, that's lowering its effect on the Consumer Price Index, but not having an effect on the Bureau of Economic Analysis measure. So the measure we focus on is not influenced by some of these government subsidies that you're alluding to. Now, on the question of taxes as opposed to subsidies, we don't directly look at the rising taxes as part of the price index, but we do look at what the after-tax wage is and how much that can purchase. So we do pay attention to what we would call disposable income, the amount of income you get after you pay the government your taxes. We do look at that very carefully, but that wasn't something we talked about today. Hopefully that got most of your questions.
Well, the only edge is property taxes. What you just said sounds like you're talking about payroll taxes and income taxes. In other words, the withholding on wages and salaries. But in order to live in anything other than under a bridge around here, you have to pay property taxes to 4 or 5 different entities. So do you measure property taxes as an element of cost of living?
We do not. We look at the tax burden on individuals, but we do not look at it as part of the cost of living.
All right. I'd like to take things a little bit more macro. You did a great job of indicating early in your presentation that you only supervise the regulated banks, and there's this whole other universe of money flow outside of that. And as most of us in the room know, a big part of the meltdown in 2008 had a lot to do with what's outside of your regulation. So I'm very curious about how you're taking that into account in the stability of the markets. How do you see that influence of shadow banking affecting the next potential meltdown?
Yeah. So some of the financial institutions that were not subject to our regulation in the past are now effectively subject to it because they merged with these big banks. So we are supervising a larger fraction of the financial system than we used to. But it continues to be the case that there are a lot of shadow banks, as you mentioned, who we don't regulate. Now, we do look and we do talk to the people who regulate those agencies. There's a number of agencies that play a role in regulation, and we talk to them and we try to collaborate, but we don't always agree, and so that's something that we continue to pay attention to. You may know that the Federal Reserve Bank of Minneapolis has put forward a plan, the plan to end too big to fail. And what that's saying, essentially, is that we haven't gone far enough, even with what the Fed can do, and Congress could do more. So we would like to see some changes that would protect taxpayers in the event of another crisis. We don't think there has been enough protection enacted. By the same token, we do realize that some of the regulations that were passed are particularly onerous, particularly for small banks, and we'd like to see some of those eased as well. So we'd like to see some regulations taken away, some different ones added, particularly on the larger banks, to protect taxpayers in the future. And we're talking to people trying to get Congress to pay attention to us on that.
Has that proposal been floated?
Yes, absolutely. If you go to our website, you can read the plan. We actually put out a draft report. We asked for comments. We had a lot of comments in, and you can go read our responses to those comments as well as the final plan that's on our website. Every time we go to DC, we go up to the Hill and we give copies of it to people and try and convince them. And some people agree openly. Some people say, I wish I could do something about this, but if I did, the banks would flood my district with money for my opponent. I can't say anything. So, we have a lot of support in principle, not so much support in practice.
Didn't TARP end with $12 billion in profit?
So there were a lot of different programs that the government got involved in during the crisis, and some of them ex post look like they returned a profit. But what I would caution you is that, the government took on an enormous amount of risk. So it's not enough that you make a profit. You should, as taxpayers, be getting enough profit to compensate you for the risk that was taken on. And I think once you take into account that risk, I don't think the bailouts were a very good deal for the taxpayer. Yes, ex post it turned out okay. It could have turned out very badly.
Hi, Mark. Simple question. Is productivity in the the wages and labor calculation?
Yeah, so I actually showed, if I can get back there, I'll show you it again. Couple of different measures of payments to workers. So this blue line is wages. It doesn't include any other non-wage compensation, and it includes no adjustment for productivity. The green line is compensation. That includes other forms of compensation, no adjustment for productivity. And this employment cost index is meant to do an adjustment for productivity. So it's there. Now, it doesn't make much of a difference simply because productivity has not been growing very strongly.
Hi. In your presentation, you talked about the regional economy doing a little bit better than nationally, and yet this Fed voted against 3 times, you had said, against a rate increase last year. So, I'm trying to figure out if you can give me a little bit more color about what the reasoning was for voting against it, or conversely, other parts of the nation that are not doing as well economically voted for rate increases. So a little bit ironic in the voting side. Just was wondering if you could give a little bit more reasoning as to why we voted against the rate increases when the economy looks to be doing better regionally than nationally.
Yeah. So the responsibility of the FOMC is to set monetary policy for the economy as a whole. And so in terms of setting that, Neil and all the different regional Fed presidents take into account the effect on the economy as a whole. So even though our state seemed to be doing well, the economy didn't seem to be doing as well as a whole, and so we had to take that into account in the voting decisions. Now, why do other people see things differently? We ask ourselves that question all the time. And I'm sure they ask that same question themselves. What are those folks in Minneapolis thinking voting this way? I think what it comes down to is you've got a lot of people looking at lots of data and making judgments as to what the most important piece of data is. And some of those judgments differ. And as a result, we worry. We worry about whether we're getting it right because we don't know what the truth is. The other thing we don't know is just how long it will take for an increase in interest rates to feed its way into affecting the economy. we typically think it happens with a lag, at least a year, maybe 18 months, maybe 2. And so it's about judging how long that lag is. If you think the lag's really long, you need to act now before things get too tight in the future. If you think the lag's short, well, maybe we can wait a little bit longer. So there's also judgment calls about that. So, we don't know the economy. We're not perfect at it. We try to cultivate a pretty diverse range of opinions at the FOMC so that we're covering all of our bases. We play devil's advocate. We bat a lot of ideas back and forth, and we come up with the best decisions we can. And the data just isn't perfect, and so people's judgments differ.
Hello. The labor force participation data that you showed spanned about 10 years. Is there any indication that the participation depression in recent years could have been caused by labor displacement by automation? And part 2, what's your perspective on that sort of displacement, given that much more automation is likely to be coming into the economy, and especially into what have been traditionally white-collar jobs or knowledge worker types of jobs? Thank you.
So that's a great question. Let me answer it in a couple of parts. So first, we have labor force participation data that we rely on that goes back until basically just after the Second World War. And if you go back, the labor force looked very different then. Women didn't participate nearly as much as they do now. Men participated even more. And what we've seen over time is that women started participating more, men were participating less. And part of that's probably related. Now some men stayed at home and some of their spouses went to work. And some of it might reflect other things that are going on as well. What was kind of a little bit concerning is that in the last 10 years, women's labour force participation has also started to go down. And that goes down even if you take out the effect of the ageing of the economy. And that's not what we're seeing in other countries. So you have to ask the question, why is it that other countries continue to add people to the labour force and the US hasn't? And exactly why that is a lot of theories about it, and in fact we'll be debating many of them at a conference here in May. One possible thing is that many other countries, particularly advanced economies, offer much more generous parental leave and childcare than the US does, and that probably plays a big role in why female labour force participation has not continued to grow and has actually started to decline here relative to the rest of the world. And now I'm forgetting the other part of your question, I'm sorry. Oh, automation. So it's interesting, people have been worrying about automation for a long time. I mean, a really long time. Aristotle wrote about the fear of automation. People invented windmills and that was going to put people out of work. In the 60s, they were worried about automakers who were going to lose their jobs because of robots on the production line. And now, of course, we're concerned about AI and what that might do. What I think is probably true is if you'd told Aristotle, hey, in Aristotle's time, 85% of people were farmers. And if you'd said to him, in the future, less than 1% of the population will be farmers and people will be doing things on what's known as the internet and playing amazing immersive video games and doing all these things, Aristotle wouldn't have believed you. And I think the lesson I take from that is that, there's always some new way of doing things, some new invention that's going to require people to work at it. I don't expect that AI is going to be able to do everything. One thing we're seeing a lot of is that over the last 5 years or so, we've seen the growth in craft manufacturing again. It used to be the case that all manufacturing was done by small manufacturing shops with crafts people working on stuff. Then we had this kind of boom in mass production, and now we're going back to craft. No more Miller Lite and Budweiser. Instead, you've got 300 different types of craft beer. You've got 500 different types of craft roasted coffee bean. You've got all sorts of other things you can do. So I kind of suspect that what we'll see is there'll be a boom in things that are not mass-produced, that are tailored, that are inventive, that are specific, that a machine just can't do. That's where I'd be placing my money. But I could be wrong. I've been wrong before.
Mark, thanks for this presentation tonight. This is a great scan of where we've been and what's happened. But it occurs to me one of the takeaways is that we've been in an expansionary economy. The economy is still expansionary, but that never lasts forever. That always ends at some point. So I'm curious, what do you think are the main risks to the expansion in our economy now? What will end it? You know, it occurs to me that the last 4 recessions that I've lived through and remember, they each had their own character and their own circumstances and their own set of causes. Have you been thinking about that? And again, the general question, what are the risks to our economy right now?
That's a great question. And you know, obviously we think about that a lot. And if we had a good hunch on what it was, we'd be working on it and trying to protect ourselves from it right now. You know, things that we look at are what's the danger of another financial crisis? You know, when we see the stock market move suddenly like it did, we worry about that. But the good news is that most of our financial institutions don't appear that highly leveraged, and so the consequences of a big financial shock seem more containable now than they used to. What other things do we worry about? Well, what if there was a war, a trade war to begin with? What if the US and countries around the world start increasing tariffs? That would increase the costs of everything. And increasingly what we're seeing in the world is that, you know, every single thing that we buy is made out of components made all around the world. Sometimes you'll make a component in Thailand, you'll ship it to China, they'll ship it to Hong Kong, ship it to Korea, ship it back to Thailand before they ship it to Mexico and then to the US. If you make each of those linkages more expensive, you make everything much more expensive, and you may have to see big changes in the economy to deal with that. So that's one thing that's come up. You know, the thing about crises is they're always a little unexpected, and you know, it could be a lot of different things, but I would worry about the international dimension as being a potential source of risk.
I'm afraid we have time for just one more question. We'll take one more, and then after that we'll adjourn. And Mark, I believe, is happy to stay around for a few minutes longer to take any questions that we don't make.
Here's what I don't understand. So the Fed is currently unwinding its balance sheet, and they have been giving quite a few dollars back to the Treasury because of the profitability of the Fed, right? So as that balance sheet is unwound, will the money going from the Fed to the Treasury also decrease? And whatever happens if the Fed fails? Can the Fed fail?
So it's true that, you know, any profits made by the Fed are returned to the Treasury. And because we've been holding a very, very large balance sheet, we've been making more profits. As the balance sheet shrinks, there's potential to make less profits, but it's possible that interest rates will rise to offset that somehow. So exactly how that evolves is uncertain. One thing I would point out, though, is that twice now, including recently, the Treasury, as a result of an act of Congress, has taken some of the Fed's reserves and appropriated them to cover expenditures. So that's also eating into the Fed's profitability. Now, can the Fed really go bankrupt? I think the answer is no, because ultimately the Treasury stands behind the Fed, and the Fed could not be allowed to go bankrupt. But even if we did and we weren't able to return profits to the Treasury, it's not like we have shareholders or somebody who are going to declare bankruptcy on us. You know, the United States creates its own money. It can print as much as it wants if it needs to. So there's no reason why it would have to. It's always possible to keep the Fed solvent. In a sense, the greatest asset of the Fed is its potential to create money, not just now, but in the future. And if you were to value that asset, this money tree that we have, that's incredibly valuable. And we're nowhere near exhausting the value of that one asset. All right. Well, thank you very much.